Hello, 5i research community. My name's Chris White. I'm the head of research at 5i. Today is Friday, April 4th, and this is the TSX weekly wrap. So it's been an eventful week, to say the least. We had the announcement of the US tariffs on Wednesday, what was named Liberation Day. And essentially following the announcement of these tariffs, we've seen the market decline materially on back-to-back days. Many stocks are down big. The markets are moving. There's lots of outlier cases and one-off market stats out there. And so in this TSX weekly wrap, I really want to get into a few key investing philosophies and kind of market psychology, but then also a little bit into what's happening in the markets. So I'm going to pull up a list of some of these investing philosophies and psychology rules that I have. So the first is optimists make more money than pessimists. So historically, the markets have gone up and to the right over a long period of time. And so being an optimist and looking towards a bright future is often going to be more profitable than, being a pessimist, looking for more downside. And especially, it can also be important not to get too greedy to the downside. Some investors, when they see these back-to-back 5+% down days, they just kind of want to wait for more down days, and I'll buy when it hits this price. But often, the numbers are skewed towards the upside. So, a stock can go down 100%, but it can go up multiples. And so, market drawdowns only last so long. And so really being an optimist can pay a lot more than being a pessimist. The second rule is volatility is an investor's best friend. This is exactly what we're seeing right now. We're seeing massive levels of volatility. And really, volatility presents opportunity in the market. So volatility usually shakes the tree, and that's when we see stocks move, and it kind of forces people's hands. But it also presents really good long-term buying opportunities. And so as investors, it's really important that we kind of take those opportunities in stride. And while the volatility is never fun to live through, historically, we've always looked back on those moments and kind of looked at them and wish we bought more, really. The third thing, the worst thing that we can do as investors is panic and either buy or sell without deliberately thinking about actions. So, the last thing that we want to be doing as investors is panicking in times like this. Number four, buying at the most opportune times is always terrifying in the moment. So, there's this quote that I like from Mark Yusko, who says, when investors feel really good about buying a stock, it's likely that they're going to lose a lot of money. But when investors feel really bad, like sick to their stomach about buying a stock, it's possible that they're going to be making a lot of money. And so, I like that quote because I've found it to be especially true. When we're excited and we want to tell all of our friends about this stock that we just bought, it's likely when it's come up a lot in price, we're more confident in it. We feel like it'll continue to go up, but then the opposite happens. Whereas when we're not that confident and the market's drawn down, 15 to 20%, and we purchase it, we're less likely to be, confident in it, but those can often be some of the best buying opportunities. Number five, markets bottom on bad news and top on good news. This is kind of like what we're seeing. This is like what we could be seeing in the near future here. Historically, the market bottoms on bad news because, let's say the market's declining and there's bad news that's coming out, and then more bad news comes out, the market declines again. Well, eventually, the market will bottom and there will still be bad news coming out, but essentially the market's pricing in future good news because there can only be bad news for so long. And then vice versa, when there's good news, and let's say for an individual stock, let's say a stock is beating earnings expectations, it goes up, there's good news about it, it makes an acquisition, it goes up again, and it keeps rising on all this good news. Well, eventually all of that good news gets priced in, and then investors kind of look toward, okay, maybe this is a cyclical kind of industry and there's going to be a downturn, and they start pricing in the future expected downturn, even though it's still putting out good news results or press releases. So with the tariff kind of dilemma, we could see further bad news on tariffs up until one day the market seemingly bottoms and we see a string of good back-to-back days, and that could still be on bad tariff news. It's just that the market is seeing through it and pricing in good news on the horizon. Number 6, investing is a game of probabilities, not absolutes. So really, no one knows what the future will hold, but we can look at data and determine the odds. And so that's really what the markets are all about. And that's why I love the market so much, is that it's not black and white. It's very much, probability based. And so really we need to look at when the odds are most in our favor versus kind of stacked against us. Number 7, data-driven insights help to keep objectivity. So that's especially what I like to do for, my investing style and how I conduct investment research. I use data and I let the data drive the narrative rather than having the narrative drive the data. Okay, so what I'm going to be doing here is I'm going to be looking at a series of current market outliers that have really been taking place recently. So here we have the volatility index. This is the VIX. And I have this on a chart since early 2020, the pandemic flash crash. And we can see that right now the VIX is about 40. So mind you, I'm recording this around 3 p.m. on Friday, so the market hasn't closed yet. So these numbers may be incorrect by the time of close. The last I checked, the VIX is around 43. But we can see above 40, this is kind of where we're at. And the last time we saw this was the Japan yen carry trade unwind in August of 2024. Prior to that, it was sometime in 2020 with the COVID kind of flash crash there. So I've highlighted these 3 kind of bands, and this is based on research that I've done. So when the VIX is in that blue zone, that's kind of 20 and below, the markets react really well in that area. So this is when uncertainty is low. There's investors are more calm. They're more confident in the markets. The markets are likely going up and to the right in a non-volatile type of way. In the yellow band, though, between levels of 20 and 30, this is where uncertainty starts to creep into the market. And we saw this really persist throughout 2022. And the forward returns historically for the market in that zone are not that great. So that's when the market's kind of in a transition zone. Now, above levels of 30, that's the green band, green area there. This is where forward returns for the S&P 500 are historically quite strong when the VIX is above those levels. Okay, another current market outlier. So we have the Nasdaq 100 is in bear market territory again as of recording this, so 3 p.m. before the close. So the Nasdaq's about 20% down peak to trough, which we've seen these levels over the years in bear markets. So 2022, it declined much more than 20%. 2020 with the pandemic, that was a very quick decline of roughly 30 or just 35%. And then 2018, it declined about 20% as well. And then 2015 was less than that, but still that was kind of a correction. So looking at this current drawdown, we can really see that, it's not really mirroring the correction that we saw in 2022, which was more of a long, drawn out, prolonged sort of decline with lots of bounces, lots of areas where investors thought that, okay, maybe this is the end of the correction. And then we carried on lower again. It could be reminiscent of 2018, where we had this waterfall type decline and things just kind of accelerated into the bottom. It's not quite as sharp as 2020 so far, just looking at some analogs that I've compared. It's not as sharp as 2020, but it looks similar to 2018 sort of waterfall type decline. So I find that really interesting. Just looking at these different bear markets and comparing them. And this is not to say that I think that we're at the bottom necessarily, but just that I think there's been a lot of pain in the markets already. And I think this is a really important juncture where we're at. Another current market outlier, oil has made its largest daily percentage decline in just under 3 years. So we can see the price of crude oil has dropped about 7 to 8% today, which is the largest single daily decline since middle of 2022. And also we can see that the price of oil has dropped below kind of a key level there around, the 65 to 70 range. It was kind of bouncing off that support for a few years. And we've broken below that now at 62. So I think that's important and something to watch. Next, we have bond yields are dropping. So Canadian 5-year government bond yields. So we can see that we have this large area of support around that, 2.6, 2.7 kind of level. And again, that's been since the middle of 2022 that we've kind of bounced off of that level. But it looks like we are breaking below that, making kind of new lows in the bond yields. And I think that's going to be important as well. And that's a signal for future rate cuts by the Bank of Canada. Okay, this is a heat map of Canadian stocks today. So again, this is not as of the close, so this could be different by the time the market closes. But what we're seeing here is something that's really interesting. We're seeing pretty much every sector decline in a pretty large fashion, with the exception of communications and some transportation stocks. So pretty much everything is being sold off, which is a real indication of capitulation to us. So what's changed over the last week or two is that in the prior weeks, although the market was selling off and declining, we saw controlled selling, very orderly selling, and a proper sector rotation happening. So when we look at this heat map, we would see more of the high growth, high beta sort of stocks selling off, like technology, financials, some industrials, things like that. But we were seeing sectors like consumer staples, utilities, and the gold miners were green. And so, the money was going somewhere and it was flowing into those more defensive sectors. But what we're seeing today is more or less capitulation right across the board. So investors kind of woke up and said, I want out of stocks, get me out. And usually that is a sign of when we're getting at least close to a bottom. Not to say that I think that we're at the bottom, but this is a good early indication that there has been a regime change in the selling and how it's done. And usually that can be associated with capitulations. Okay, so next, moving on from kind of like those current market outliers, but just looking at like the VIX. And I know I talk about the VIX a lot, but I really want to hone in on it because I think it is important and it's a good way of gauging kind of market sentiment. So even while the market goes up and to the right, the VIX kind of oscillates in this flat kind of sideways range. And that's really important to be able to gauge at what point, like where we are in the market cycle. So this is a scatter plot that's looking at the VIX against the forward 1-year return in the S&P 500. So going left to right, we see the VIX. So, at low VIX levels is on the left and then really high VIX levels on the right. Up and down is the forward 1-year returns in the S&P 500. So up is a really strong forward 1-year return and down is a negative forward 1-year return. And so what I've done is I've highlighted where the VIX closes above 40 or at 40 and above. And what we can see is since 1990, there's only been 8 instances, 8 days where the VIX closed above 40 and the forward 1-year return was negative. Outside of that, all other instances when the VIX closes at 40 or above were positive. And we can see that it's outnumbered multiples to the 8 instances there. So, and also the numbers are important as well. So the 8 negative instances were 20% negative forward returns or less. But the forward positive returns were pretty substantial. There's a big clustering around the 20 to 30% range, and then obviously above and below that. But what we can see is when we see the VIX close at these historically high levels, it really indicates that something has changed in the market, that something material has happened in the market. And historically, the forward returns are quite strong. So again, on the VIX, this is a table that I've created. This is data that I've compiled over the years and something that I find very valuable. So essentially, what we're looking at is kind of the VIX ranges on the left-hand column. And then there is that column that says time spent at these levels. So we can see that the total amount of time when that the VIX spends above 30 is about 8%. So like 8% of its time is spent at VIX levels of 30 and above historically since 1990. So really that signals that these kind of occurrences don't happen too often. And especially if we do close the VIX today above 40, the VIX historically has been above 40 just 2% of its time. So a really rare occurrence. And then looking at the forward return, so we have forward 1 year, 2 year, 3 year, and 5 year returns for the S&P 500 at those VIX ranges, we can see that it's more green, it's more positive, the higher the VIX. So when the VIX is above 40, the forward 1 year return in the S&P 500 historically has been 32% on average. Forward 2 year return 49, 3 year 48, 5 year 85, and so on and so forth. And so this is again signaling that while today might not be the bottom, this indicates that historically these have represented pretty good buying opportunities. And next, looking at the economic calendar for next week. So on the Canadian side, it's pretty light. There's really not too much happening. But on the US side, we have inflation coming in on Thursday and then PPI on next Friday. Thanks and have a good weekend.